We're taught that firms borrow from banks in bad times, but issue bonds in good times. But is that true during the bad time caused by COVID-19? Olivier Darmouni of Columbia University has been analysing corporate balance sheets to find out. Olivier, welcome.
Thank you. Hello, Tim. Thank you so much for having me.
Now, Olivier, what's behind this textbook assumption that we all have that it's banks that provide the liquidity in the bad times?
Well, in some sense, that's really what we think banks are supposed to do, aren't they? Right? Normal investors, normal people like us, give them money so that they can lending out to the people that need it. When do people need money? Well, in bad times, you would think about restaurants trying not to close down, not want to fire their employees, try to keep running. If their sales are going down, they're going to need credit from their banks to keep going. So, we really think, and regulators too, this is what they think banks are special and have special privileges, is because they have to step in when borrower needs funds just to bridge the gap, right? That's the role of finance. It's not necessarily to make lots of money. It's to try to help people bridge the gap when there's a bad time. So that's really what we expect. And that's why we think government guarantees are there for, is to make sure that banks are there when their borrowers need them.
And is this the behavior that we saw in the first half of 2020?
Well, to be honest, no. When we look at the data, we do seems to think that many firms actually prefer not to borrow from their bank and didn't actually receive from banks. A lot of the, and that's interesting. I want to focus on the bigger firm today, although I think smaller firms are also interesting. Bigger firms actually prefer to turn to financial markets as opposed to banks for their funds. And that's a little bit surprising, because we would think in bad times, this is the time where markets are panicking. And we expect that's exactly why banks are supposed to be here. They're supposed to be the safe haven that you can turn to, that are isolated from these market panics. And we actually tend to see the opposite. We see large firms deciding to actually not borrow from their banks, although they had what we call credit line agreements, loan contracts signed in good times that are supposed to use in bad times, actually deciding not to use them very often at all, and instead turn to financial markets to raise money there.
And the firms that turned to the financial markets, was it both the investment grade firms and the high yield ones as well?
So yes, although it is a matter of a degree. So the safer the firm, the more likely it is to ignore banks entirely. But what we have found in our research is that pretty clearly there's a lot of high yield, riskier firms that still decided to ignore their banks entirely. Of course, that there's still some of them that decided to borrow from the bank, just like there's some investment grade safer firm that did. But to a large extent, yes, it is not just a question of IG firms go to the bond market and high yield firm go to their banks. That doesn't seem to be what we see.
In your research, you investigated this by looking into the bond issuers' balance sheets. What more are we going to learn from this level of microdata?
Yeah, well, two things I want to say. One thing is when you look at markets, you only see flows. You see, did they raise some debt? But we don't know what is the net impact of that, because if you raise debt to pay back other debt, then it's not clear that you actually have more funds available to run your business. You might have just tried to swap one debt for the other, and in some sense, you're pretty much where you started. So, that's the first thing, is that it's not because we see spikes in issuance, in flows, that it means that the net position of firms have changed. And if they haven't changed, we're not sure the real economy is going to take off, although issuance has been skyrocketing. That's the first thing. So the firm balance sheet will show you what's the net position after they issued all this debt. And I think that's very useful to not just be focused on the flow data from the market, but look at the firm position. Now, the second thing that's useful about balance sheets is that you can try to see what they're doing with the funds. Again, that's something that the market data doesn't tell you, that you see that firms have borrowed a lot, but what are they doing? We're hoping they're doing this to not fire people, maybe to keep investing so that the recovery will be faster, but we don't know. They could be hoarding cash, they could be repaying other loans, and so that's why we want to look at the balance sheets.
On the question of the amount of issuance, first of all, your comparison was with 2019, a year earlier. It's the obvious comparison, but are you sure you're doing a like-for-like comparison here, looking at the same sort of firms?
Yeah, so actually that's interesting. That's a big part of our research was asking Are the firms that are borrowing in 2020 the same that borrow in 2019? And it's not obvious what to expect. You might think it might be weaker firms that are borrowing in 2020 because it's such a bad time. They're more exposed. They really need more funds. And the safer firms might say, I'm going to sit this one out. This is not the right time to borrow. But actually, we see the opposite. So it is not exactly a like-for-like comparison, but it doesn't go in the direction that you would expect. It's actually stronger firms that are earlier in their cash cycle, firms that have issued more and more recently that borrow, which again casts actually doubt of whether this big spike in issuance we see, this V-shaped recovery in bond market, would lead to V-shaped recovery in real activity if it's the stronger firms that are borrowing. So interestingly, yes, it's not exactly like for like, but if something it's going in a direction where that makes us even more doubting whether this rebound in bond market is going to lead to any rebound in real economy in the short run.
And with the results of this dash for cash that there was in the beginning of 2020, what did the firms use this liquidity for?
Yeah, so this is something that, as I pointed out earlier, that you can figure out by looking at the balance sheets. You have to look carefully into what happened there. And what we see clearly is that these funds are not used for investments. They're to a large extent not reinjected in the firm's operation. They tend to be used for two things. Either they're hoarded as cash, so you just borrow and stash it up and don't touch it. So that doesn't go towards, paying any payroll right now or financing any new project, sadly. Or even more striking, and I think this is one of the main new insight of our research, is that a lot of it is going towards paying back existing bank loans. So that's even less conductive to an increase in recovery. I think there's two interesting things about that. The first one is that going back to the textbook views that banks are so good and so reliable in bad times, that's why we need to give them all this guarantee and all this government support. Firms have revealed to us, like what economists call revealed preference, that actually they don't want bank credit in bad times. So that's cast a doubt on whether banks really have this comparative advantage that we think give them the right to so much government support. So I think that's like, from an economic policy making, we care a lot about that. And the second is, of course, that if you're using these funds to repay bank, in some sense, a lot of the bond proceeds, the market rally was probably driven by the Federal Reserve, something we can talk more about. That would imply that some of this support to Federal Reserve didn't really end up going in the pocket of firm, but more into the pocket of banks. And I think, banks are not in trouble in this crisis. They don't seem to be the one needing help. So I think that's the second thing that we can learn from looking at firm balance sheets and use of bonds proceeds.
Given that so many of these firms had credit lines set up, just ready to use, do we have a good insight into why they chose not to use them?
Yeah, so this is a very interesting question. And this is, I think, is something that in our research, we're really trying to get the community to think much harder about that. I think this idea of, what makes banks in our classical textbook theories better than bonds are misleading, and they're missing a lot of important things. If you actually ask practitioner and look carefully at the loan contract data for bank loans versus the bond contract data, you'll see that there's actually a lot of advantages in having bonds rather than bank loans. I think one thing that is absolutely clear to both practitioners and academics that are expert in this area is that loan contracts are a lot more intrusive. The banks has a lot more discretion in actually whether they want to change the terms, take some funds away for you if things go south. Well, bonds are much more passive. A deal is a deal. You sign it, and then you leave me in peace for the duration of the credit agreement. While banks can have a lot of lever they can use to poke around. So this is actually a feature that we say funds are much more committed than bank loans. And that's a good thing, especially in the COVID context. Firms need funds for a while. They don't know how long this is going to last. The last thing you want to do is your borrower to come back in some months and pull the rug under your feet. And so this is why bonds is particularly attractive. It is true it's harder to convince bond investor to lend to you, but once you did, they will leave you in peace for a while. And I think this is what firms are looking for. They're looking for peace. They don't want in 2 months banks to go and check on them and make sure that they are creditworthy again.
You mentioned that the Fed stepped in early in the crisis, Olivier, to support the bond markets. How important has that been?
So that's an excellent question. I think what we can really say right now is that, yes, it has been really important, but what we don't know yet is exactly how. And that's going to take us some time for us to unpack. For us, academic and just in general observer, the Fed has done so much in so few weeks that it's going to be hard to disentangle which part of what they've done has been the driving force. But let me say two things. First, it is clear that the Fed intervention was obviously important to stem a market panic. I think that's clear. And it's true that this is very useful because it's very hard to issue bonds during a market panic. So that's definitely true that there was very little bond issuance at the peak, like March, end of March, early April, peak of the crisis. But then once the Fed stepped in, the panic receded. There's still a question, though, of why we're in a huge recession right now. We're reaching such high level of bond issuance, as high as historical records, as high as 2019, both for risky and safer firm, where everything was so rosy. So I think the fact that the Fed stemmed the market panic doesn't completely answer the question of why we're back at such high historical level. One possibility is just that investors have so much faith in the Fed that they somehow a little bit maybe irrationally anticipate that these bonds are completely safe investments, which the Fed action, by the way, doesn't guarantee by any means.
I mean, the Fed's intervention is just one aspect of why this is not a normal time. It's not a normal crisis either. What's your intuition about this? Has this changed that we're talking about here? Is it a one-off event, or do you think this is a secular shift in how the bond market's used?
Yeah, I think there is a more secular trend that 2020 just happened to hit in the middle, if you want. I think we've seen globally a big rise in what we call market financing, including bonds and other types of non-bank financing for firms. If anything, this is the biggest banking trend since the Great Recession. It's kind of that a lot more parts of the global economies are moving towards market financing, and bonds being a big part of that, although not the only one. I think this is absolutely something that's the combination of a lot of trends, as you correctly suggested. I think very low long-term interest rates are very good for market financing. There's a lot of appetite for trying to find higher, more risky assets on the side of investors across the globe. And for this, dollar or euro denominated corporate debts issued by big firms is very attractive. So I think that's the trend towards larger and larger bond supply. Then I think there's a second trend of lower and lower loan supply. Banks in the US have been, and globally been subject to tighter regulation. That's very clear. That just makes everybody, the whole system shifts towards a little bit less banks. And then in Europe, it's different. It's not just regulation. It's just that we're inheriting a lot of terrible, weak balance sheets from the Great Recession, from the Euro crisis, now from the coronavirus crisis. Banks' balance sheet in Europe are kind of in shambles. And so I think companies that can move towards markets are also trying to do that. And the COVID crisis is just intersecting this trend. I do think there's a big implication, though, for policymakers, because the way we typically think of implementing credit policy, trying to boost credit, is through the banking sector. And I think first, there's a lot of it has migrated outside. It's not exactly in the shadow, by the way. I wouldn't call the bond market shadow banking. It's not. It's perfectly transparent, but it is market-based. And there, intervening through the banking sector is not going to help so much for that. And then, also it means that just the way we think we can help the bank to lend more is just more difficult in a post-financial crisis world where bank balance sheets are more constrained by regulation and kind of poor performing loans. So in some sense, the Fed and the ECB have taken special steps to expand their mandate of lender of last resort to the bond market with all this new unconventional policy, which I think is the right step to do going forward. But that requires a paradigm shift in how we think about credit policy. So I think the COVID crisis is revealing some of these differences that were in the background for many years, which I've been working on, way before the COVID crisis started. And I think now it's particularly easy to get attention to policymakers that maybe they need to revisit their toolkit in kind of in a deep way.
As you say, a paradigm shift, huge implications for policymakers. Really interesting research. Olivier, thank you very much.
Thank you so much, Tim. It was a pleasure to speak with you this morning.
The paper's called Crowding Out Bank Loans, Liquidity-Driven Bond Issuance, and it's by Olivier Darmouni and Kerry Siani. It's in COVID Economics 51. Well, keep up with all the research on COVID-19 and COVID economics. It is, as ever, free and open access at CEPR.org.